All right. Today is Tuesday, February 8th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. And let's start by this. I don't have in focus for you tonight, and the reason is we have a lot of discussion in the commodities market segment because we're going to talk about inflation. It is getting really scary at this point. There is a type of inflation right now going on in this economy, matter of fact, the global economy, that is unstoppable, regardless of what the Fed is about to do. But let's talk about the market a little bit before we segue to the other segments. We start with this. We have many indicators suggesting that the market is primed to rally. The market is ready to bottom and start a new rally. Among these indicators is this one. The headline reads, investors hedging this much usually precedes U.S. stock gains. What are they talking about here? Here it is, and I wish I had a better image of this one. It's a little blurry, but you can get it. We have the S&P 500 in white, and then we have the hedging index in yellow or orange, whatever that is. And as you can see, every time we get these readings, these elevated readings of hedging, that is an indicator that we have excessive pessimism in the stock market. What does that mean? Usually, not always, but usually, it is a reliable contrarian indicator suggesting that perhaps the market is ready to bottom and start a new rally. Yet, there is a flip side to this coin, and it is, what if we could go a little higher? The reading could go a little higher, and we have yet to find the bottom. That's number one. Number two, the current route in the stock market is different this time around. It is unlike anything we've seen, except 2018, when the Fed started tightening the monetary policy via the autopilot interest rate hikes. As Jerome Powell suggested, the market crashed 20% until the Federal Reserve backed off. A lot of market observers and a lot of market participants are assuming that this will happen again. The problem is, back in 2018, we did not have inflation. This time around, we do, and it is an entrenched inflation in this economy. So before you use any of these indicators, be it sentiment indicators or technical indicators, you must ask the question, what got us here? Meaning, what got the stock market to these elevated readings? And what got us down? What was the reason behind the current market rout and the double-digit correction, specifically the Nasdaq, since the beginning of the year? The answer is the cocaine. What is the cocaine, you might ask? If you are new to this channel, the cocaine is the liquidity, the trillions and trillions and trillions of dollars printed out of thin air from the Federal Reserve, flooding the financial system with excess liquidity, and that excess liquidity creates too much cash, chasing few assets, and hence inflation. Not just in the stock market, but in the commodities market, in the bond market, in the real estate market, and now in goods and services. Doesn't take a genius to figure that out. And then what was behind the stock market rout since the beginning of the year? The answer is the expectations of the removal of the cocaine that has been supporting the stock market for many years now. What does that tell us? What really matters for the stock market is not really the fundamentals, it's not the technicals, it's not the sentiment indicators, it's not the thing, it's not the politics, it's not civil wars, it's not natural disasters, it's not asteroids hitting the planet, it's not nuclear wars, it's not the extinction of humanity. The market doesn't care about any of that. The market cares about one thing, and that is the cocaine. That's all there is. Because the Fed's cocaine allows irrational exuberance across the stock market, where you have institutional investors, and you have mom and pop retail investors, and you have pension funds. You have international investors. You have entities, be it state or government entities or whatever entities, investing in the stock market irrationally. Why? Because they say, well, we have the Fed. The Fed has our back. The Fed is pumping the stock market, and therefore, it doesn't matter what valuations are. It doesn't matter whether stocks of companies actually have revenues or profits or not. It doesn't matter what the multiples are, because we got the Fed behind us. Now, you take the Fed out of the picture, and all of a sudden, all of these things matter again. Valuations, fundamentals, etc. So yes, this indicator is suggesting that the stock market is ready to bottom and it is ready to move higher. The problem is, if the Federal Reserve problem is not solved, meaning the Fed continues to be hawkish and move closer toward tightening the monetary policy, the stock market will not recover. Regardless of the technicals, regardless of the sentiment indicators, regardless of the so-called money on the sidelines, regardless of the pumping, regardless of anything. So keep that in mind. And here's an important take, perhaps some insider information. This ex-Fed insider warns of difficult few years of high inflation. Once again, few years, not transitory, not a few weeks, not a few months. Few years. And he also adds, if you are a wage earner, you're going to fall behind. This is a dire warning to what's about to happen. You haven't seen anything yet in this economy. What is this man saying, by the way? Because it is a prediction that a lot of you hold. On the economy, he says, it is going to be a very difficult couple of years for the U.S. economy and the Federal Reserve. If they raise rates to bring inflation down, then the hard part begins. Because when that happens and the economy begins to slow, they'll worry about a recession. There will be a likelihood they will ease policy again, even while inflation remains 4 to 5%. Pay attention now, because this is important. What he's saying is, the Fed knows that inflation is a major problem, and they will indeed tighten the monetary policy. Perhaps by the shock and awe approach comes March. They will bump rates by 50 basis points. This will crash the stock market, no doubt about it, and it could slow down the pace of economic activities and growth dramatically. But there is no guarantee that doing so will control inflation. And hence, we have a stagflation threat to this economy. The Fed believes, and again, these are the same geniuses, by the way, who predicted that inflation will be transitory. So you take whatever they say with a grain of salt. But their plan right now is to buy ammo. What do I mean? They're going to raise interest rates higher, perhaps by 50 basis points in March. And maybe a little beyond that comes the June meeting. But what will happen in response to that is the stock market will crash down. And you and I know we have an economy that traces the stock market, not the other way around like it's supposed to be. Back in the day, we had a stock market that traced the economy. Now we have it the other way around, thank you to the financial engineering by the Fed. If the stock market crashes due to interest rates moving higher, then the economy will slow down dramatically. Perhaps we will lose jobs. Perhaps we will see the pace of economic activities slowing down dramatically. And certainly, economic growth will go negative. Meanwhile, inflation could go down from 7 to 8%, according to the CPI, of course, to let's say 5 to 6%. Under that circumstance, we're going to have stagflation, high inflation, and a slowdown of the economy. Now, here's the Fed's fantasy in tackling the stagflation crisis. The Fed believes if they tighten aggressively, and yes, they're going to crash the market, the real estate market, but that is collateral damage for now, since the rich already got out. The corporate insiders, they already sold at the top. So if you're buying the dip right now, you are collateral damage. But the Fed believes by doing so, they're going to take the inflation out of the stagflation. Inflation will go down, and yes, the pace of economic activities will crash, but in doing so, by raising interest rates higher, they bought ammo. And after they take inflation down, the plan is to ease once again. Now that they have ammo, they have room to reduce interest rates again. See what I'm saying? This is the plan. Tackle inflation first, and then we start greasing up the economy and the stock market by easing. So easing will come back on the table. This is at least the plan of the Fed right now. And a lot of you believe that, by the way. A lot of you in the comments, I read your comments, and you say, forget about the Fed tightening. Sooner or later, they're going to have to ease once again. You might be right, but buying the dip right now under that assumption is indeed suicidal, because we're going to see the collateral damage part first, and then the easing comes after the disaster. Here's my warning to this fantasy. If the Fed insiders and the Fed officials are listening to this program, we know that they do, at least the staffers, but here's the warning. You will not get inflation down by doing that. Inflation will surprise you for how sticky it is. If you think you're going to jack interest rates by 50 basis points, maybe another one, 75 basis points, and that will do the magic, and now you have 75 basis points as ammo to reload again once inflation is gone. This is a fantasy. It's not going to happen. Why? Because there is an element of this inflation that is unsolvable by the Federal Reserve policy, and that is commodities inflation. We will talk about that and a lot more in the commodities segment in a few minutes. But let's start by covering the market information, and we start with the market performance today, and here we go. The Dow Industrial Average closed in the green, gaining 371.65 points, or a gain of 1.6%. The Nasdaq also climbing higher, gaining 178.79 points, or a gain of 1.28%. The S&P 500 obviously in the green by 37.67 points, or a gain of 0.84%. What about the sector's performance today? Leading the pack at number 1, capturing the gold medal, consumer cyclicals. The number 2 for the silver, materials. Number 3 for the bronze, technology. The laggard of the day is energy, and I'm going to explain to you why in the commodities segment. But before we do that, how about the advance to decline ratios? NYSE 70% advancing versus 27% declining. The Nasdaq 65% advancing versus 31% declining. The breadth is a little better today, but you have to approach it with a grain of salt until the CPI comes out. Moving on to futures, commodities. What do we have here? We start with crude oil. Crude oil is down, be it the WTI or Brent, almost 2% apiece. We also have gasoline down along with heating oil. Even natural gas was down by a little over half percentage point. Stay tuned for commodities news in a minute. But before we do that, how about softs? We have gains led by lumber. Massive gains for lumber, 4% today. And then we have coffee. Coffee surging higher by over 2.5%. And I will explain to you why in a minute. But here it is, OJ finally finding a footing and surging higher by over 2.5% today. Likewise, cocoa almost gaining 1.5%. And cotton, the laggard of the gainers, gaining a little over 1% today. Sugar, pretty much on the flat line. What about metals? We have muted activities for gold, silver, and copper, while we have noticeable gains, a little over 1% for platinum. On the other hand, palladium was the loser today, losing over half a percentage point today. What about meats? Live cattle, pretty much on the flat line. Feeder cattle futures gaining a little over 1% today. And look at this, the new big tech. Lean hogs gaining over 2.5% today. And look at the contrast of performance between the Nasdaq and lean hogs. Year to date, lean hogs, the new big tech, has gained almost 20% in value. On the other hand, the QQQ, the Nasdaq, is down almost 10%. So once again, when I say the new big tech, I'm not lying. Lastly, what about grains? What's going on here? We have gains led by wheat, oats, and soybean meal futures. On the other hand, we have losses led by soybean oil. Soybean oil was down big, over 3% today, followed by rough rice, soybeans, canola, and corn. Let's move on to commodities news, and we start with the WTI crude oil prices. Now, here is what I said about the WTI's chart just a week ago. Take a listen. We start with the WTI crude oil. What's going on here? You can see a trend of higher highs, and if that continues in this leg, we will go higher by about 5% before we face overbought conditions and we see a pullback. And here it is, exactly a little over 5% gains, and then the WTI, at least so far this week, is down, pulling back. Now, pretty much every single chartist out there was predicting this. Everybody was looking at the same chart, and we all knew that the WTI will face resistance once we bump against that line. The problem is when everybody piles in on one side of the trade, assuming that something is going to happen, and pretty much everybody has expected the pullback once we bump into resistance. And a lot of folks are saying perhaps crude oil is topping, perhaps the WTI is done here. And I say when everybody assumes that one thing is going to happen, usually, not always, but usually, the opposite happens. And in this case, my bet is we're going to see a pullback, but sooner or later, WTI prices will blast above the resistance line in yellow that you see in the chart, and we will see a reading of 100 sooner or later. What about natural gas? You hear the news, and they're talking about Russia and Ukraine and the tensions and yada, yada, yada. But seldom when they talk about the economic aspect of this crisis, specifically what's causing the tensions. Primarily, it is the natural gas crisis. We have a deal between Germany and Russia, in which Russia will supply Germany and pretty much the rest of the European Union with gas, and this will be an important source of income for the Russian economy. The United States doesn't like that because they view Russia as an adversary, and hence we have the tensions between the US and Russia, and in reality, Ukraine is just collateral damage here, and we have Germany caught in the middle. They're not sure what to do here. Do they please the old ally, the US, who, in their view, is making a big deal out of nothing? The Germans are asking, what is the big deal here? We have an economic need. We need natural gas. Russia's close enough. We have a pipeline that will supply us with cheap gas. What is the big deal here? The US says it's a red line. You don't do it. Otherwise we don't know. We just don't want you to do it. And hence we have all of these tensions. But behind the scenes, the United States has been supplying Germany and the European Union with a massive amount of liquid natural gas. And this is all being done via shipping, which is not the most convenient or reliable way to secure supplies of natural gas. Pipelines is the way to go. But regardless, we've been shipping so much natural gas to the European Union that freight rates right now went to zero. It costs nothing to ship natural gas from the United States to the European Union. So there is a cold economic war between the United States and Russia behind the scenes. Nobody's talking about this in the media. And of course, we have the little tyrant from France, President Macaroni, who's trying to play diplomat right now, and he went to Russia and met with President Putin. And of course, this is predictable, by the way, from President Macaroni. After visiting Russia, he visits Ukraine and he says, I got a deal with Putin. And then Putin comes out and says, hey, we did not get a deal whatsoever. I had tea with the guy and I sent him out. Goodbye. We didn't have any deal whatsoever. President Macaroni believes that he's smart enough to squeeze Putin into a deal that didn't really happen. And now the crisis is intensifying. And the conflict is really important when it comes to natural gas prices. For now, European natural gas prices have cooled down due to the insane amount of shipping from the United States and rerouting, by the way, from Asian destinations to the European Union. But that will all change once Russia cuts the supply 100%. Natural gas prices will shoot up higher, and it doesn't matter how much we're going to ship to the European Union. It's not going to be enough. In the meantime, natural gas prices will spike, and hence it will open investment opportunities, at least trading opportunities for us in natural gas related names, mainly fertilizer names. When we talk about energy, we have to talk about coal, because coal prices, by the way, the best performing commodity of last year. Why? You'll see why in a minute, but coal prices are surging again. And this is causing a massive energy crisis now in Australia. It's not big right now, but it's about to happen because coal prices, Australia is one of the biggest producers of coal. So the economy will benefit, not the people. The people will be stuck paying high utility bills as coal prices move higher. Unless, of course, the government initiates some sort of programs to compensate households for the extra increase in energy costs. But regardless, the headline reads, coal soars to $300 a ton as Asia scrambles for power plant fuel. Another one, China battles to contain coal price surge as dependency worsens. And as you can see, these Central Appalachia coal prices are moving down a little bit. Not by a lot, they remain highly elevated. But the most tradable coal commodity here is the Australian Newcastle Coal Index. And as you can see, back in October, we've seen a crisis as prices surged out of whack and then they came down. And what did I tell you back then? Coal prices will move higher again because it doesn't matter what commodity are you looking at. Have you noticed that pretty much every single dip in commodities is being bought, be it in coal, be it in the WTI, be it in natural gas, be it in lumber, be it in coffee, be it in copper, be it in grains, be it in meat? They're buying the dip. A lot of you buy the dip in the stock market. It's not working so far. But buying the dip in commodities, as I've told you and I taught you before, is working tremendously. And coal is just one example. Now prices are moving higher and it's going to cause a crisis. Why are coal prices moving higher? Perhaps this explains it right here. This man that you're looking at right now is known as India's Coal King, and he has witnessed the most rapid increase on an individual wealth in history. We have never seen somebody gains that much wealth in a short amount of time like this man. He shot up higher, and now he is the richest man in Asia and the 10th richest man in the world. Soon enough, he could be the richest man in the world. Number one, if the stock market crashes, tech goes down, but inflation sticks and coal prices move higher. And the assumption is coal prices will continue to move higher. So you're looking at possibly the man who's going to be the richest person in the world. And why is this happening, by the way? The answer is the green lunacy of rapidly shifting from fossil fuels to so-called green energy when we don't even have green energy secured. We have years and years of work to do in securing solar, in securing windmills, in securing electric vehicles. In the meantime, we're crushing the fossil fuel industry, including coal, and hence the supply goes down of all of these fossil fuels while the demand continues to move higher because we need them in the meantime while we transition from fossil fuels to so-called green energy. The transition should be gradual, not an abrupt one like we're seeing right now. And by the way, the so-called green energy, not so green. Do yourself a favor and look at nickel mining, lithium mining, cobalt mining, all of these elements that goes into the manufacturing of electric vehicle batteries. They produce high amount of pollution, perhaps on par with the fossil fuel industry, if not worse. But hey, who cares? We have these insiders, the politicians, the rich, who already invested in the green energy way back, and the way they're going to market it is, it's better for the planet. When in fact, all they care about is money. All they care about is getting richer. That's all there is. They could give a rat's ass about the planet. What about softs? Again, we talked about coffee. Why are coffee prices surging out of whack? You're gonna pay more for coffee, I promise you. And the reason is, listen to this headline. Coffee reserves plunged to the lowest in more than 2 decades. Look at this. Unbelievable. In white, coffee futures in New York surging to multi-year highs, the highest reading since 2012. In red, the stockpiles. They're pretty much at all-time low. This is the kind of inflation that is unstoppable, regardless of what the Fed is going to do. We cannot print 3D coffee. We cannot print 3D hogs. We cannot print 3D cows. We cannot eat virtual oats and corn and soybeans in the metaverse. If there are no supplies of these commodities and the demand continues to be high, inflation will continue to move higher and higher and higher. So it doesn't matter what Powell is going to do. It doesn't matter if he thinks he's a genius and he's going to buy some ammo by the shock and awe policy of hiking interest rates higher. Yes, damaging the economy, but then inflation goes away. And hey, look at this trick. Now we ease again that we have a little bit of ammo and the economy recovers without inflation. Sounds like a fantasy, isn't it? And it is one, because how is that going to solve the lack of supply of coffee? How is that going to solve the climate crisis when you don't have crops? Stockpiles of high-end Arabica beans, a favorite of artisan coffee shops and chains like Starbucks, totaled 1.078 million bags, or about 143 million pounds, according to data released Monday by the ICE Futures U.S. Exchange. Listen to this. That is the lowest level of inventories monitored by the New York Exchange since February of 2000. Wow. What about metals? Perhaps we can find some relief there. Not really. The headline reads, Americans face record metals prices as shipping costs surge. It's not only the fact that we have a shortage of supply in metals, be it aluminum, be it copper, be it nickel, be it whatever. Tin, zinc, doesn't matter. It's also shipping rates are surging out of whack right now. What does that mean? We have an insane demand problem, fueled by the Fed's cocaine, and the Fed has to reduce the demand in this economy. Ongoing, the thing-triggered snarls are boosting the cost of trucks and rail cars to move things around. Let me fix this one for you. Here we go. Causing delays in shipping materials to consumers. Manufacturers of products are paying a record price to get hold of copper and aluminum, key metals used in everything from wires to electronics and automobiles. The benchmark price to ship copper in the U.S. is at the highest in data going back to 2003, while the cost of transporting aluminum now accounts for 20% of the metal's total price. Wow. Boats are stuck out of the sea and rail doesn't have enough staff, so rail yards are crowded and my materials is stuck behind 1,500 cars, so they have to dig that out, and it takes days to do that, said Gillespie, who works for one of the nation's largest suppliers of wiring. He also added, the perfect storm is having a ripple effect and people are calling for metal, but the material is just not there. The situation is even more severe in aluminum, which has seen its premium over prices on the London Metal Exchange for U.S. Midwest delivery surge more than 40% in the past 2 months. For buyers, that translates to an additional $768 per metric ton on top of the raw material price for about $3,100 a ton. That's a huge increase, folks, for shipping alone. And this is the same gentleman once again adding, they put me on quota. If I want to buy 500 pieces of copper, they tell me they'd send me 50. When I get the delivery, maybe it's 10. I don't see anything where it's getting better. And that's actually not the same gentleman. That is Richmond, who buys from domestic manufacturers and sell products to companies like Amtrak. He also added, now everybody wants to get back to normal and everybody's ready to roll. I have a lot of business, but I just don't have the materials. These could be my best years if I had the material, but I don't. And look at this. Aluminum prices, the highest levels since 2008, and we are now at record highs. Wow. Now, let's talk about grains commodities, and we start with soybeans. Let's hear what I said about soybeans and corn a few months ago. Take a listen. But here's my call. Remember, I have been bullish on corn since November of last year. I have been buying corn and I have been advocating for corn prices to go higher. I think the corn trade is over now, yet the momentum might continue for soybeans instead. So I will be shifting from corn to soybeans. And exactly the rotation from corn to soybeans was successful, and the reason is, look at the year-to-date performance. Soybeans soybeans gained over 18%. On the other hand, corn gained only 7.3% year to date because the tailwinds for soybeans are a lot stronger for corn. With all of this massive inflation in grains prices, you might say, well, farmers are doing great, right? U.S. farmers are rolling in cash. Not really, which by the way is yet another indicator that grains prices will move higher and food costs for you and I, the consumer, will also go higher. The headline read, U.S. farm income expected to fall as costs for fertilizer, other production expenses climb sharply, and this is according to the Des Moines Register. Agriculture Department economist Carrie Litkowski said the agency expects U.S. farm income to fall to $113.7 billion, down $9.7 billion or 7.9% from 2021. Last year's farm income hit the highest level since 2016, with corn and soybean prices closing in on record highs set in 2012 and 2013. Watch out here, because farmers are not going to eat a loss. Farmers have to make money, otherwise it doesn't make sense to produce. When natural gas prices are moving higher, pushing fertilizer prices out of whack, they're going to have to increase the prices on their products. Now, the suppliers who are going to buy these products from the farmers will incur an extra cost due to inflation. Where do you think that extra cost will be passed? The answer is all the way down to you and I, the consumer. We're going to pay more. And again, you read all of this and you're going to use your brain. What commodities that I should be in right now? So far, we talked about aluminum. So far, we talked about coal. So far, we talked about copper. So far, we talked about fertilizer prices. You got to use your head here. Continuing. The Agriculture Department expects the costs to raise crops and livestock will grow 5.1% to $411.6 billion over the 2021 figure, with the price of fertilizer climbing 12% and for livestock feed 6.1%. This year's expected hike in expenses comes on top of a 9.4% increase last year. Wow. So again, inflation is not going to go anywhere. Inflation is just going to go higher and higher and higher. And you cannot stop it, Mr. Powell. You got to be really, really aggressive to slow down the demand in this economy. And perhaps it will require a recession. And by the way, the figures from the U.S. Department of Agriculture, just like the CPI, is toned down. In reality, farmers are paying a lot more. Here's a farmer, Lilybridge, said the increases he's seeing are far greater. He said his fertilizer costs are up 300%. The costs of herbicides, pesticides, and other crop protection products are up 100 to 150%. Wow, unbelievable. It makes you want to throw up, he said, adding he expects his fertilizer costs will be $190,000 more than last year's by the time this season ends. And look at this. U.S. exports, agricultural exports are surging, be it to China, Mexico, Canada, other countries. Yet the farmers are losing money. The margins for farmers are going down. They're not going to stay in business with lower margins, despite the Venezuela socialist-like programs by the government of giving checks to farmers to keep inflation down. At some point, farmers will look around and say, it's not worth it. We gotta hike prices higher. We gotta get more for what we're paying. And that means higher prices for you and I, the consumer. It also means higher inflation in this economy. Lastly, what about oil? We're talking about cooking oil here. And the main concern when we talk about cooking oil is India, the largest consumer of cooking oil on the planet. As you can see, whether we're talking about peanut oil, whether we're talking about rapeseed oil, whether we're talking about soy oil, sunflower oil, palm oil, all of these oils, the prices of these oils, year over year, moved higher. So again, inflation is moving higher. And this is tragic, by the way, because despite all of these increases in prices, palm oil remains the cheapest out there. What does that mean? When we look at India's imports of oil, the vast majority, 63%, is palm oil, followed by soybean oil, sunflower oil, and then others. The problem with palm oil is the following. It is destructive to the planet. The deforestation is unbelievable in the countries that produce palm oil. And this inflation will make palm oil, regardless of the price increases, more attractive because other options are getting way more expensive. So on top of higher inflation, expect more deforestation and perhaps extinction of wildlife. Thank you to Jerome Powell. Let's move on to options, the big casino. The hottest table by far is Apple, with almost 930,000 contracts traded today. About 68% of those were calls. And at number 2, Facebook, Meta, with a little over 850,000 contracts traded today. About 64% of those were calls. And at number 3, Exxon, with about 575,000 contracts. About 93% of those were calls. We have dividend for Exxon tomorrow, I believe. Moving on to the unusual activities that took place in the options market today, we start with the ticker FB, Facebook. They continue to buy calls here, but in reality, they're catching a falling knife. In this case, they bought the $240 calls for the expiration date, February 11th, with expectations that Facebook could pop higher by more than 9% by then. They paid about 43 cents apiece to enter this trade, all in all spending about $1.3 million. What about the trades for the ticker XOP? This is the oil and energy ETF. They're buying puts. The WTI is down. Perhaps it could go a little lower. And therefore, they're buying puts, in this case, the 99 puts, and they're selling the 88 puts. So it's a spread with different expiration dates, meaning it is a calendar spread. In this case, buying the 99 puts, the expiration date of March 4th, and then selling the March 18th 88 puts. In other words, this trader is confident that whatever drop we have in oil right now, it's going to be transitory. The dip will be bought and we will see a recovery in oil prices because they're leaving the credit spread, the 88 puts that they're selling, for a longer expiration date. They're confident that that leg will expire worthless, but they're only leaving the insurance, the 99 puts, to expire a few days before that. They paid about $2 a piece for buying the 99 puts for the expiration date March 4th, and then they received about $1 a piece from selling the 88 puts with the expiration date of March 18th. All in all, they reduced their entry cost to about $1. They paid about $2.5 million. The protection lasts all the way till March 4th. After that, they better hope the XOP is trading above 90, at least. Next, what about the ticker PTON, Peloton? Somebody's fading the rep here, buying the 35 puts for the expiration date, February 11th, with only 3 days till expiration. With the expectations that Peloton would drop down by more than 6% by then, and they paid about $2 a piece to enter this trade, all in all spending about $4.5 million. What about the trade for the ticker NIO? They're buying puts here, the 22 puts for the expiration date March 11th, with the expectations that NIO could drop down by more than 11% by then. They paid about $1 a piece to enter this trade, all in all spending about $2 million. What about the trade for the ticker BABA? For Alibaba, they're buying puts big time here, the 115 puts for the expiration date March 11th, with the expectations that the name could drop down by more than 5.5% by then. They paid about $5.50 a piece to enter this trade, all in all spending about $7 million. What about the ticker MNDT? This is a cybersecurity name, and it popped significantly higher today on the heels of earnings, and somebody's betting for more gains to come by buying the $20 calls for the expiration date February 18th, with the expectations that the name could pop higher by more than 12.5% by then, and they paid about $1.20 a piece to enter this trade, all in all spending about $800,000. Moving on to the heat map analysis, what do we have here? The number one observation is the weakness in energy. Exxon down, Chevron down, pretty much everything is down in energy, and the reason is the drop in WTI prices. We'll see how long that's going to last, but for now, energy remains the best class of assets to be in. So the dips will be bought here, no doubt about it. Another notable decliner today is Facebook, Meta. It remains trading down. A lot of dip buyers. A lot of traders are buying call options, but you got to be cautious here. And the reason is you're fighting a tsunami. What is the tsunami? You're fighting a tsunami of exodus from both institutional and retail investors who are exiting their investment in Meta because things have changed. The company is losing users for the first time in its 18 years history, number one. Number two, Not everybody's buying the lunacy of the metaverse. They're planning to spend billions and billions and billions of dollars to build a glorified video game that they want to call the metaverse. Not a lot of folks are buying that. Margins will be bad, the net income will be bad, and the only appeal for Facebook stock, at least was, its valuation, number one. Number two, the fact they have an insane profit margin. That's not going to happen anymore if the company's about to spend billions and billions and billions of dollars to build the metaverse. So if you're buying the dip right now, you're running against an avalanche of selling. You gotta wait till the selling stops before you start buying the dip. And you better believe in the company when you buy the dip. You better believe that the metaverse will be the next thing. Otherwise, if you're just buying the dip because you think it went down big, it's gonna rebound big, it's gonna go back to all-time highs, you're smoking a lot of good stuff here. Another notable decliner is the biotech sector, specifically Moderna, on the heels of Pfizer's earnings. Pfizer down almost 3% today after bombing their earnings. The irony, of course, is all of these celebrities are probably part of the jab cult. They're probably all sponsored by Big Pharma. But anyways, the stock went down due to the miss in the top line, meaning revenues. But the bottom line, profits went higher, beating by a wide margin. And the reason is the revenue from the jabs. So this company should be in financial shambles, absent of the revenue from the jabs. And I found this alarming, by the way. The CEO of Pfizer came out today and said that he expects to generate record high revenues in 2022, saying it expects to sell $32 billion of the Think shots and $22 billion of the other thing that should treat the thing of that thing. And I say $54 billion this year when the worst is supposed to be behind us? Are they cooking a new variant here? Perhaps. Another notable mover today was down in the morning, but it recovered in the session, is Nvidia. We have news, we already knew that, now we have a confirmation that the ARM deal is, poof, gone, out of the window. Not gonna happen. Yet the geniuses continue to buy the dip in Nvidia stock. Why? It is a good stock, it's a good company, but it's way overvalued. A lot of the fluff in the stock was due to the ARM deal. Well, the ARM deal is out now. More notable movers, this time to the upside, Harley-Davidson up big. Over 15.5% today. We talked about this stock in yesterday's video. And pay attention to this, by the way. The headline reads, Harley-Davidson reports a surprise profit and strong demand in its home market and higher motorcycle prices padded earnings. The reason why we pay attention to earnings, we want to find companies that are winning in this inflation, meaning they're jacking prices higher and the consumer is still receptive. We had an example in Tyson yesterday, and today we have Harley-Davidson. They're moving prices higher, and the consumer remains receptive, at least for now. These are the kind of stocks you want to be in this environment. How about this one, the crisis in Peloton? The name was down big in the pre-market, but it recovered in the session, and the reason is the criminal CEO Foley is finally stepping down after he dumped tens, if not hundreds of millions of dollars of his own stock at the top, when he knew, by the way, he had advanced knowledge that the company is about to deaccelerate significantly because they ramped up the supply, expecting the high demand to continue. And by the summer of last year, they put two and two together, the projections, and they found out that the high demand is not sustainable. And now they have a problem of oversupply and no demand. And all of a sudden, magically, Foley and the rest of the executives in Peloton, they dump hundreds of millions of dollars of stock. What do you know? The next thing is the stock crashes on the top of the heads of the retail crowd, losing hundreds of millions of dollars, if not billions. Where is the SEC, you might ask? The SEC remains in a coma. But Foley's out now. He scored big. And they have another one. Peloton names tech executive Barry McCarthy to replace CEO Foley, who unveiled a plan to cut costs. Uh-oh. This is tragic, folks. As Peloton fires 2,800 employees, it is giving them a free 1-year subscription on the way out. You want to talk about adding insult to injury? Because this is what it is. These criminals made hundreds of millions of dollars, knowing that the company is going to go bust. They screwed the retail investors who believed in this company, and they screwed the hardworking employees who made this product possible. Unbelievable, and you cannot make this up. And you wonder why the Gen Zers and the millennials are becoming anti-capitalism, because this is what they see in the capitalist system: scams, fraud, pyramid schemes, and the rich always wins. The poor, the middle class, the employees, labor, investors end up losing. Anyways, moving on to the heat map analysis for the ETFs in the stock market. As you can see, energy is the biggest loser by far. XOP, XLE down big. Everything else is working here, with the exception of the XBI, the ETF for biotech and real estate. Real estate is down because interest rates are higher. Likewise, utilities pretty much in the flat line. The XLU once again because interest rates went higher. Financials continue to move higher. Chips specifically moving higher. Retail recovering. Materials also moving higher. And look at the contrast between value and growth. Both in the green, but growth is outperforming value at least for now. For example, look at the IWF for growth, gaining a little over 1% today, while the IWD gained almost 0.7%. Not a wide margin, but growth is outperforming value for now. The problem is the outperformance of growth is not sustainable. It keeps coming up and then it goes down big. Yet the growth in value stocks, ironically, is sustainable and intact, steady eddy since the beginning of the year. And as investors, we're looking for stability. Stability is in value, not in growth, at least for now. When we look at international markets, they're all in the green, yet the notable winner is the RSX, the Russian ETF, blasting higher, on the heels of the optimism that perhaps President Macaroni could score a deal here. I wouldn't bet on that. We also have the EWW, this is the Mexican ETF, blasting higher, and I'm going to talk about international markets, specifically Mexico versus Brazil, in another video. But for now, we got to move on and cover charts, and we start with SPY 30 minutes chart for the S&P 500. What's going on here? The answer is nothing is going on here. The SPY is still trading within range. The support at around 446.5. You can round that down to 446. Doesn't matter to me. It's a zone, not a specific number. The resistance at around 451. For now, the chart is just doing ping pong between support and resistance, waiting and waiting for the CPI. Let's read the psychology here for a minute. The psychology of the bulls versus the psychology of the shorts. Let's say and assume that we're all anticipating the CPI before we make a major move one way or the other. And this is the truth, by the way, at least for me. I'm waiting to the CPI. I want to see what happens. If you are short and you scored big, the risk versus reward says you should start covering. Why aren't the shorts covering for now? Meaning, while we wait for the CPI, why isn't the stock market moving higher significantly? The answer is perhaps the shorts are confident that after the CPI we will see a resumption of the selling in the stock market, and therefore they're holding the line. Which, by the way, could fire back if the cooks give us a, shall we say, tamed CPI reading. Then we will see a lot of short covering. Likewise, let's read the psychology of the bulls. The bulls are waiting and waiting and waiting for the CPI before they start buying. There is no FOMO now to rush ahead of time because you have no guarantee whatsoever that the CPI will be favorable, specifically when we look at commodities prices. So what are the bulls doing right now? They're waiting. They're waiting and waiting and waiting. Maybe some are dipping in for a little bit to score a day or two worth of gains and then get out. So the expectations are, at least for now, that the market will remain stable within range. A little bit of buying, perhaps a little bit of bias to the upside, but as we get closer, the CPI's reading, those who bought the dip with the short-term mentality, they're gonna get out. So expect a dip, another pullback before the CPI reading. That could be tomorrow. That could be Thursday in the morning. And by the way, the bulls are betting on the fact that we're making higher lows, at least for now. And here is a daily chart for the continuous contract for the SPY, the S&P 500. For now, so long as 4,472 is intact, the bulls are closing in. The chart is starting to favor the bulls. The momentum indicators are curling higher. The volume is slowing down. The most important support line, 4,472, is intact, and we could be seeing a formation of a bull flag pattern or a formation of an ABC pattern. We discussed all of these patterns in previous videos. So for now, does the chart favor the bulls or the bears? The answer is it favors the bulls, at least for now, until and unless the support of 4,472 is lost. What about the Qs? The Nasdaq 30 minutes chart once again. Within range, the support 352, the resistance at 360. We're going back and forth, back and forth. You go down to 352, you buy the dip. You go up to 360, you get out. In, out, hello, goodbye. So the assumption for now is, now that we're at 360, we could pull back and retouch 352 before the CPI comes out. The bulls might be a little courageous here by pushing the chart all the way in an attempt to close the gap. It's a long shot, but it could happen under low volume. until the CPI comes out. And here's the daily chart for the continuous contract for the NASDAQ. The magic number is 14,445. It remains intact. The chart has been testing over and over again this line, and it continues to hold. Is this behavior bullish or bearish? The answer is it is bullish. On top of that, the momentum indicators are curling higher, the volume is slowing down, but we're seeing more buying this time around. All of these are bullish signs. All of these are good signs for the bulls. And by the way, market bulls have a good case. Let's remove all of these lines out of the chart. We had a drop before, top to bottom for around 8.5%. So far this year, we got another one, perhaps a bigger one, top to bottom, at least for now, of around 18%. Then, in the correction of last year, we got a bull flag pattern, signaling a bottom, and since then, the chart moved higher to make all-time highs once again. The bulls would argue that this time around, it's no different. The chart is forming a bull flag pattern, and before you know it, the chart's going to move to all-time highs from this bull flag, just like it did before. It's an intriguing case, but the bears will counter with this. The bears would say, I don't care if you have a bull flag or not. You might be right, but look at this. We had a trend that goes all the way back to September of 2020. That trend was broken. It's gone. It's done. They say the trend is your friend until the very end. Well, we are at the end now because the trend is gone. But in typical charting behavior, the charts don't just flush down in a straight line. They have to trace back these important lines: support, resistance, trend lines. So yes, you might have a bull flag pattern for now, but that will take you all the way to retest that trend line, and you gotta fail from that point on, because it is a rarity to see a long trend line broken like this and the chart reclimbs the line like nothing happened before. Moving on to the IWM 30 minutes chart for small caps, the Russell 2000. Nothing is happening here, still within range, 196.5 as support, 204.5 as resistance. They buy the support, they dump at the resistance. These are day traders, of course. So the expectations are, if we get to 204.5, they're going to book profits ahead of the CPI. Nobody wants to take risk, a lot of risk at least, before the CPI reading. Here it is, the daily chart for the Dixie, the dollar index. It remains below 96, but it could retest that level again, because this is typical charting behavior. You don't break a trend line like 96. Look at how long the chart of the dollar index has been consolidating at 96. Holding. It's not going to give it away quickly. It's going to continue to try and reattempt to climb that number until we have a hard rejection. And a hard rejection is confirmed when the chart pulls down and breaches another support level, in this case, 93.7. What about gold? What's going on here? The old man is moving higher by a little bit, perhaps, giving it another shot at breaking above the 3 amigos, but for now I'm keeping my bear flag until and unless the retest of the 3 amigos 1,835 is successful. Here's a daily chart for the 10-year yield, moving higher, no stop inside here, and we're eyeing 2%. Perhaps it's going to top at 2%. Perhaps the CPI will come out favorable to the bulls. They're going to cook the numbers here. I promise you. We top at 2%, and then what happens? The NASDAQ blasts higher. Everybody says we overdone it with the expectations. Interest rate hikes. Look at inflation. It's cooling down. Yada. It's part of the game, folks. The cooking, that is. But the facts don't lie. Inflation is not going to stop. And the risk here is, if this reading comes out really hot, despite the cooking, then we can breach over 2% and the NASDAQ pulls down once again. The bar is a little too high, by the way, for the CPI. We know it's going to be above 7%. Will 7.2, for example, shake out the market? I don't think so. How about 7.4? Maybe. But if we get over 8% or even better, double digits at 10%, then we will see the freak out scenario. Moving on to the TLT weekly chart. What's going on here? Still pulling back. We have to retest 134.5 before we do anything in this chart. Moving on to the VIX 4 hours chart. What's going on here? Look at the MACD indicator. It is producing a red impression on the histogram, perhaps signaling the end of the rally in the VIX. We need a confirmation, and the best confirmation is closing the week below 20. We have a few days left here, but a good sign for the bulls is the gap is now closed, and the chart of the VIX closed below the gap of 22. This is a good sign for market bulls, not VIX bulls. Yet market bears will hang their hats on the fact that the VIX is still trading above 20. They'll say, okay, no problem. We go down to 20, retest 20, and we bounce from that point on. So the bears are not going to be silenced in this market until the support of 20 in the VIX is gone. Moving on to the VXN 4 hours chart, we're watching a bull flag pattern, but it is melting down. The MACD indicator is also melting down, producing red impressions in the histogram, and these columns are getting larger, not shorter. These are all good signs for the bulls of the Nasdaq. But you're not out of the woods yet. Who's to say that that's not going to pop higher again? You gotta wait till the magic number, 27.5, is breached and the chart of the VXN closes the day and preferably the week below that number. Then you have a confirmation that the Nasdaq is out of the woods. Here's a daily chart for Apple, still good, a bull flag pattern, reclimbing the support of 172.4. So far so good, and you and I know as Apple goes, so will the market. Here it is, an hourly chart of Tesla, the souffle, still consolidating, no move whatsoever, waiting and waiting and waiting for more buyers. The buyers are not that stupid, by the way, meaning the dip buyers. They'll buy dip in names that are becoming oversold, that are really crushed, the valuations are way down. They're not going to buy the dip in Tesla unless they're forced to, because Tesla has another shoe to drop. It remains a highly overvalued name. This is risk-on territory. The name is holding because the retail crowd, a major holder of Tesla, still believes in the name. They don't care about valuations, of course. When they bought the name, they bought it because Tesla's the future, bro. The robo-taxis, the flying cars, the satellites, yada yada yada. And I ask, where are the robo-taxis? They were supposed to come out in 2019, right? The risk for Tesla is if the holders are forced to sell, and they're going to be forced to sell if margin calls hit. Meaning, we're going to see more pain for the stock market, the broader stock market, before Tesla falls down. If this consolidation pattern finds buyers and the buyers finally show up, then the chart is going to run up a test at 995 for resistance. If not, if the buyers don't show up, then the chart will go down to close the gap at 846. Moving on to BTC, tulips, what's going on here? It's going to retest 42,000 as support, and if that holds, then we have a bullish sign that you have to go ahead and buy BTC, at least all the way to 53,200. The problem is, what if the retest of 42,000 fails? Hence, the disciplined approach right now is to wait till we see how 42,000 is going to hold once again. And lastly, AMC, we have a major move today for over 10%, so we have to cover the chart. This is an hourly chart. The question is, are we seeing a saucer bottoming formation? That is the case, then the chart will run a retest at 21 for resistance. And here's the thing, the implied volatility in AMC remains low. Now, if the market's reaction from the CPI is bullish, meaning favorable, stocks move higher. It doesn't matter what the reading is, really. If it's too high, then we got a problem. If it is within range, then the market could brush that off, shake it off like Taylor Swift, and move higher again. There will be an opportunity for a trade here in AMC to ride it higher all the way to 21 and then book profits. Lastly, moving on to the economic calendar. What do we have tomorrow? We have a revision for wholesale inventories, and then we have a bunch of Fed zombies speaking from Cleveland. Who cares? Now, what do we have on the earnings calendar? We have CVS, a lot of bullishness for that name, PepsiCo, Toyota, Yum Brands, Mattel, Disney, Uber. The goal here is to find which names are good inflation hedges if they're raising prices and the consumer remains receptive. If the revenues are going higher year over year and higher than the rate of growth of expenses. If PepsiCo delivers, the stock will shoot up higher. If Yum Brands deliver, the stock will move higher, etc., etc. And with that, folks, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.